Hello, welcome to the Capital Employed podcast. For this episode, I had the pleasure of talking with Steven Kiel from Arquitos Capital. Arquitos is an unconventional hedge fund with a great track record that invests in a small number of unique companies. In this episode, Steven talks about his investment philosophy and process. He also talks about 3 companies he is currently invested in. Before we jump into the conversation with Steven, we will be publishing some exclusive interviews that will be solely available to those on the Capital Employed email list. So if you want to listen to these future bonus episodes, please visit capitalemployed.fm/exclusive and add your email to the list. Okay, without further babbling from me, please enjoy my conversation with Steven. Thanks, Steven, for coming on to the show. For listeners who may not be familiar, who and what is Arquitos Capital?
Yeah, well, thank you, John, for having me on. I started Arquitos Capital in 2012. Basically, they call it an unconventional hedge fund invested in a small number of unique companies. So my previous career was as an attorney. I worked for a public policy organization as well, so kind of came from outside the business and had done well running money for kind of friends and family. And then started out in 2012, kind of spun off from my legal work to launch Arquitos Capital. And, here we are 9 years later. We've taken over a small public company, which we'll talk about later in the podcast here. Built a great network of fellow managers, done a lot of interesting transactions, and basically had a lot of fun along the way.
The funding behind Arquitos, is it sort of institutional money, or do you keep it more fellow investors who kind of understand investing in smaller companies?
Yeah, we have, I think, 65, a mid-60s number of investors. And since it started out with people who I was connected with, when I first started, not coming from the industry, primary investors were kind of friends and family, people connected to me. And then over time, that expanded. We've picked up some family offices and some other, a couple interesting fund-to-funds, other things like that. But, I think primarily it's individuals still, and to the degree that they understand investing in kind of these smaller companies or these types of special situation things that we do, I think it's a little bit more of they appreciate the philosophy and respect, the long-term nature and perspective that we take. And you're always looking for investors that are committed over a long time period, especially when you have a concentrated portfolio like we have, where you can have significant volatility over the course of several years.
And what type of industries and companies do you invest in?
There's no specific industry, kind of a generalist in nature. We're really looking for more special situation type of things. Some of those special situations, these are company specific things, can transition into longer value oriented holdings. Where do you get the mispricings early on when you first discover a company? Where does a misunderstanding come from the market versus the intrinsic value of the company? Generally, that's when a company is going through some sort of transition. There's something specific to the company happening. So we've had things through the years where I invested in companies a number of years ago that had these net operating loss carry forwards, these tax assets. That went away a little bit a few years ago when the tax law changed. We've done things like spin-offs. We've done different event-driven things. We invested in a bankrupt ice company. It's coming out of bankruptcy back in 2013. That was a tremendous investment for us. And, today we're heavily invested in a company that is going through activist investor litigation. It's a wide range of things. We'll look at any industry that we can reasonably understand, that has the fewest number of variables inherent to the industry itself. So that rules out a few industries. Generally looking for those special situations and company specific things that we can ballpark the potential result and attempt to get some sort of predictability over time to back up the thesis of the mispricing today.
And how do you find these companies?
Well, I think it's important to go to the original sources. There's a lot of kind of secondary research out there, and it's fine. That secondary research is fine for giving some background information for checking your work and different fact-related things. But ultimately, when you go to the SEC filings themselves, when you go to the news and different presentations, whatever the company is putting out, that's a great way to find new opportunities. Look for insider buys. There's things cluster insider buys because you really have to be humble to the fact of what the company itself knows, the insiders know. And that's what I learned kind of being involved in a small public company myself now, that there's so much going on behind the scenes that the outside passive investor is just not going to know until after the fact. So how do you ride along or ride the coattails or find something before others? How do you find the opportunity before it's kind of actually already happened, And so if you've got a cluster of insider buys, if you've got share buybacks at reasonable prices, if you look at the incentives provided, to management and the board, those can be opportunities as well. And so, through different SEC filings, that's the primary way that, we kind of do the research. And then, of course, talking to the company, talking to fellow investors. And ironically enough, there's a tremendous amount of idea sourcing on like Twitter and Google alerts and things like that, where you put in keyword terms for different companies, different situations, and different activist investors, for example, or other smart people that might get involved, in a company out there that you can find. And obviously, you want to do your own research, and you have to own the idea yourself. But it's a great way to come up with, a nice watch list.
How many companies do you normally hold in your fund? Is it quite concentrated?
Usually around 10 to 12, sometimes 15. It depends what's going on at the time. Sometimes we'll own a basket of things. But the top 5 companies generally make up 75% of the portfolio. That's the way I like it. I think you have to do it in a way that matches your personality. And I'd rather go really deep into one company than spread myself out over a large number of companies. It would get kind of maybe fixated or obsessed with one company itself. And so if you can be patient and find a company that really has a low amount of risk of capital, actual capital loss, forget about volatility itself, but you're looking for the risk of actual capital loss, permanent capital loss. And if you can find a great opportunity like that because of mispricing, in my opinion, and the way that I approach it is that you have to take full advantage of that and make it a significant position.
Do you mainly focus on the OTC markets, or do you look international as well?
No, we'll own anything. We got a couple companies that are on the OTC markets, but most of the companies are SEC filing. They're on NASDAQ, New York Stock Exchange. We've gone overseas a couple times, but it's been a little bit more rare. So we're generally North American, looking for North American type of companies. But the idea is what can I understand and what can I feel comfortable with? And so if you're looking at something overseas, you really have to have a deep understanding of what's going on, the risks. And, so that takes a little bit more work, takes a little bit more perspective. And there's quite a few more in the too hard pile for that. So we're primarily looking at North American companies in a little bit more predictable, industries and situations.
Can you talk us through 2 companies in your fund that you think will have good returns going forward? What's the thesis for investing in those companies?
Well, we're involved in a small public company called Enterprise Diversified, and I'm the chairman of it. And, I'm really excited about the long-term prospects here. We've owned it for about the last 5 years, 6 years or so now as we're getting into 2021. The thing that's exciting about Enterprise Diversified is the asset management company called Willow Oak Asset Management. This is the subsidiary. It's 100% publicly or 100% owned by the public company. Basically, Willow Oak takes fee shares in other investment funds in exchange for providing operational services. Provided a seed investment to Alluvial Fund about 4 years ago, and then we provide operational services for several other funds, and we're looking to expand that. So, this is a type of business that the economics can be extremely attractive over long time periods. So there's an initial kind of investment by, on the operational side for the resources put out by Willow Oak. So it's kind of a loss leader there. And then as time goes by, as the funds grow, as the performance is, as their performance fees earned and things like that from those funds, if we look forward 5, 10, 15, 20 years, the fee shares can be very significant. Of course, the manager himself makes quite a bit as well. And so when we do that, we're looking for funds to partner with that have that long time horizon, that are willing to be around for a long time, that are willing to commit. And these are permanent relationships. Not every one of the funds is going to hit it big. I think as we've chosen some very smart managers who are going to be around for a long time, have different niches that they're invested in. The funds themselves are going to do very well, which will benefit their investors, of course. And then Willow Oak Asset Management also will do very well.
The ticker for that is SYTE. Is that correct? Enterprise Diversified Inc.
SYTE, that's correct. And then, for kind of a second investment, I'll give a basket of things. I mean, we're invested in a few different things that we're excited about right now. It's been the last 6 months have been a very exciting time. We've had a tremendous start to the year here and tremendous Q4. So, there's a company called Tai Property that is going through litigation right now in BVI. This is actually a Chinese company. I first found it many, many years ago from Marty Whitman from Third Avenue, and more recently was reintroduced to it by my friend Thomas Brazil. This is a company, there's an activist investor that got involved in it. They're attempting to reverse a private placement that was done last year. That private placement was done at a price kind of similar to today, but the true value of the company is many multiples of what today is. And the litigation seems to be going well for the activists, but if that happens, there'll be a flood of buying, or there'll be potentially a buyout offer at several multiples of today's price. Even if the activists are not successful in the litigation, the certainty after the trial, I think, provides support, for other investors to get involved. The primary shareholder there had been buying shares at twice of today's price. They put in a huge private placement about 4 years ago, at twice of today's price, and had put out information suggesting that the company was worth in the $40 range. This was several years ago, and it trades about $9 right now. So we're excited about that. There should be a resolution here in the next few weeks, and whether there's a buyout offer or something else, I think this is one that's already done great for the portfolio in the last couple of months. It's doubled and has more room to run. I've also been a long time involved in a company called MMA Capital, and this is a company that provides solar financing for solar lending. They control a fund, and then they have various other holdings. They have tax assets and net operating loss carry forwards, and it appears they've done very well even through the crisis here. But the price compared to intrinsic value of the company, the book value has really widened right now. The stock's trading at $23, the book value is $38. They're coming out with $38, not counting the tax assets. They're coming out with their Q4 results in a couple of weeks. I expect them to be very good. This is a company that used to be a huge cannibal. They were buying back 8 to 10% of the stock every year for a 5-year time period. And then the last couple of years, they've set that aside because they've seen better reinvestment opportunities in the company itself. So we'll see where that goes. But it's really been amazing to me to see that gap even widen during this time period where the stock market itself the last couple of years has done very well. Companies like MMA have been set aside, right? These are traditional balance sheet value names, and they are extremely out of favor right now. And these are safer places to be when we get when the market starts to kind of become a little bit more rational at some point in the future. It's anyone's guess as to when that'll happen. But once the speculation dies down a little bit, a company like MMA Capital is extremely safe there. And on the other hand, even if the speculation continues in the market, if MMA were to decide to sell itself, or they use up the NOLs and sell themselves, or even if they were to liquidate, which is not something they're going to do, but if they did, you're looking at a 50%, perhaps a 75% gain just from the liquidation itself. And, if we try not to be too greedy here and amortize that over several years, we'll be very happy with that return.
Seems very cheap as well, good value.
Yeah, and when I first was buying into it in 2014, I think my first purchase was around $7. So we're still happy with the performance. But the last couple of years, it's dropped from 30 down to about 23, and that's had a negative effect on our performance, as it was a big piece of the fund. The actual risk there was very low. Risk is the opportunity for permanent capital loss, not volatility. Just because the stock price goes down, that says nothing about risk. And the company itself is, because the stock price of it has gone down, the risk itself is plummeted. Obviously hindsight is 2020, but we're still very happy with buying into a $7 stock and owning it at $23 over a 6-year time period, a 7-year time period. But obviously the last couple of years, the market has kicked it to the curb, which is an opportunity for other investors to take a look and potentially find opportunity there, find value.
Thanks for sharing those 3 companies. They all look interesting situations. Are you an avid reader? And if so, what book have you recently enjoyed reading?
Yeah, so I've gotten away from investment books the last few years and gotten a little bit more into more psychology and human nature and those types of things, and even kind of marketing related books. Alchemy by Rory Sutherland was a great book I read a few years ago, and that actually led me to a book I'm currently reading called The Enigma of Reason. And this is a book by Dan Sperber and Hugo Mercier. To put it in a nutshell, the theory is that something called the Justification Theory, which it's saying that the rational mind basically provides justification for what the kind of spontaneous mind does. So you can think of like Kahneman and the different theories that he has. This is actually taking the opposite approach. And it's a very interesting perspective, an interesting book, and where it's saying that, the rational mind and reason actually is kind of like press office, in the administration, for example. It's not the decision maker. We can't rely on reason and rationalism. It's there actually to mislead us or to justify the decisions that we have already made. And so I'd encourage people to take a look at it. I think there's a lot of that in the stock market today, and certainly in day-to-day life, where, basically you've got a lot of what might be considered irrationalism, but people justify that, because of from their own reason, and really made me much more humble to the value of kind of spontaneous decision making and feelings. Making decisions based on kind of gut reactions and feelings, because in a lot of ways, those gut reactions and feelings are taking all of your knowledge, all of your experience, and subconsciously pushing you in one direction. We should not discount the value of that.
So where can listeners find out more about Arquitos Capital and about yourself?
You can go to the website, arquitos.com. It's ARQUITOS. I'm fairly active on Twitter as well, which is Steven_Kiel. It's Kiel. So, always happy to kind of interact there, looking for stock ideas all the time. So appreciate anything you've got there. And we actually, Willow Oak Asset Management handles the operations for Arquitos Capital as well. And so you can find a little bit more information there at willowoakfunds.com.
Okay, that's great. Yeah, thank you so much, Stephen, for coming on. It's been really good listening to you.
Thanks, John. I appreciate that.